In our outlook for 2015, we at BlackRock have been recommending a higher exposure to the high yield market. This is a very important part of the U.S. Bond market. Specifically, these are corporate bonds issued by companies that tend to be in a very high growth stage of their development. So they are looking for funding. You can find them in several type of industries, and investors like these type of instruments because, as its name refers to, it pays a higher yield than the average of the market, and it tends to be somewhat of a shorter duration, meaning that the maturities are somewhat lower than the government bond market of the U.S. Treasuries, for example. As we know, we are living very challenging times for the fixed income investor. Yields are very low in Europe, in Japan, also in the U.S., as there's a lot of liquidity that's being injected by central banks around the world. In this low yield environment, high yield offers us a much more attractive return. Now, it is, of course, instruments that are exposed to the credit risk, which is normal from corporate issuers. But given that the U.S. economy has been increasingly improving over time, we are seeing the best fundamentals for this type of issuers. So combining the yield and better fundamental perspectives, this is probably the best time to be looking at high yield for an investor. When we look at the U.S. rates hikes that are expected to be starting at the end of this year, or probably initially of 2016, we believe that high yield offers a very good protection. And why do we see this? Because it has a very high spread against the U.S. Treasury. So this spread really acts like a cushion, like something that will protect the investor for the time that rates are going up. And I would add that we have to remember that rates are going up for a reason, because the U.S. economy is doing better. So that means that the issuers, the companies, are actually seeing a better prospects for their business as well. Again, high yield is a very attractive option for an investor at this time of the market. HYG is the ticker of BlackRock's iShares ETF in the high yield space. Is one of the most actively traded ETFs in the market. It is a very big ETF. It's currently around $16 billion. So it has both retail and also institutional investors. It is also very liquid in terms of trading. Currently, we are seeing daily average volumes of around $700 to $800 million per day. This is very high as well. So both in terms of size and of liquidity, we think it's a very interesting vehicle to gain exposure to this market. And in terms of sectors, we have several of the sectors that are typical in the high yield space. We have, of course, the telecom industry. We have, as I mentioned before, energy-related companies. We have companies in the healthcare space as well. It is a rather shorter maturity type of index, as high yield bonds tend to have shorter maturities than other type of corporate bond issuers or U.S. Treasuries as well. So it's a very well diversified, very liquid, and very sizable vehicle to gain exposure to this market. This is a ETF that will pay a dividend. It will pay as a dividend the income it receives as part of the coupons of its underlying assets, of the bonds it invests in. So we're looking at yields that are paid as coupons in the ETF of around 5 to 6% in dollars on an annual basis. In summary, we believe that at this moment of the rate cycle in the U.S., high yield and specifically HYG is an excellent option, offering a very interesting prospective return in a well-diversified, very liquid instrument.